What's up, everyone? Again, long time no see. Been very busy. Just finally got done removing my case to federal court. Holy crap, that was a lot of work, but I'm finally done, and I have a minute to breathe. But I noticed that on the 2nd of December, we had an important filing come through from the OCC, which is the Options Clearing Corporation, that is very relevant to anybody trading short-term options, which is essentially everybody. Now, the title of this filing is Self-Regulatory Organizations, the Options Clearing Corporation, Notice of Filing of Proposed Rule Change by the OCC concerning enhancements to the system for theoretical analysis and numerical simulations, or STANs, and OCC's Comprehensive Stress Testing, CST, methodology to better capture the risks associated with short-dated options. Now, what this means, we're going to go over this real quick. Basically, they're implementing enhancements to STANs and the CST methodology. The focus is the risks of short-dated options, SDOs is what they call them, aligning day count conventions, extending term structure of implied volatility shocks, and it's going to be impacting both system for theoretical analysis and numerical simulations, and again, the comprehensive stress testing, which is CST. So the day count convention alignment, what this is, current issue basically is a mismatch between calendar and trading day conventions. The solution that's proposed is align the conventions for consistency in option price smoothing and implied volatility modeling. The result of this should be improved accuracy in margin calculations and stress testing outputs. They're also going to be extending the term structure for IV, which the current limitation is flat term structure for options with less than 1 month maturity. The proposed enhancements include shorter tenures, for example, 1 week or 2 weeks. The result of this is better coverage for portfolios dominated by short SDOs. What did we say that was? Short dated options, sorry. So better coverage for portfolios dominated by SDOs. So again, this is highly relevant for retail. Now the impact analysis, the average daily increase of margin is going to be about 0.58%, or in a dollar value is about $0.2 billion. The range of impact is going to be anywhere from 0.81% to plus 3.21%. The CST impact, Cover 1 and Cover 2 shortfall variations are going to be 3.17% to 1.16%. And then the clearing fund size reduction is going to be 0.14%, or about $14 million reduction. And again, the clearing fund is essentially all of the collateral that's posted for margin by all of the participants in the OCC. So the implementation and timeline, the integration into the productive system should take anywhere within 180 days of the regulatory approval, which again, it was filed on the 2nd. So once it's approved, it will take about within 180 days to take effect. 2 weeks prior to its implementation, there will be an announcement via information memorandum, which you can actually register to receive those on the OCC's website. And that's basically it. So I'm going to go over the filing itself now. This is the actual filing. And I'm just going to run through this real quick. It's not too long. I'm just going to give you more context here. So again, they're changing STANs methodology description and comprehensive stress testing, clearing fund methodology, and liquidity risk management description, which are contained in Exhibits 5A and 5B to file number SR-OCC-2024-016 respectively. The material proposed to be added is marked by the underlying, and material proposed to be deleted is marked with the strike-through text. So that's typically what you'll see whenever they amend documents like this. Anything new will be stricken out. Anything new will be underlined, and then anything old will be stricken out. Within the documents, new, revised, and deleted text related to the proposed rule change have been incorporated in sections 2.1.3. So let's go to the purpose real quick. So the background to this, the risk framework for the OCC includes STANs, which is used to calculate clearing member margin accounts, and its CST methodology used to stress test clearing member portfolios in order to determine the appropriate size of the clearing fund and allocate portions to clearing members commensurate with risk they present to the OCC. STANs is their proprietary risk management system for calculating the clearing member margin requirements, which utilizes large-scale Monte Carlo simulations to forecast price and volatility movements in determining a clearing member's margin requirement. And this is pursuant to Rule 601 of OCC. Now, they use a smoothing algorithm to generate theoretical prices and volatilities for option contracts based on the fair value for plain vanilla listed options from closing bid and ask price quotes. And this is referencing a Exchange Act release number 86731 from August 22nd of 2019. Or in other words, you can reference SR-OCC-2024-016. OCC does this by first filtering out certain poor quality quotes on contracts based on certain conditions and estimates the forward prices of the securities underlying these options. OCC then generates the theoretical option prices based on the filtered bid and ask quotes and constructs a volatility surface. And a volatility surface refers to a three-dimensional plot of the implied volatilities of the various options on the same stock, reflecting time to maturity and different strike prices for the options. The output of the smoothing algorithm, consisting of various theoretical option contract prices and volatilities, is then used downstream as a starting point to simulate variations in implied volatility for options contracts. Now, using the Black-Scholes options pricing model, the IV is the standard deviation of the underlying asset price necessary to arrive at the market price of an option of a given strike, time to maturity, underlying asset price, and the current discount interest rate. So they're basically telling you how they calculate it right there. Now, in effect, the IV is responsible for that portion of the premium that cannot be explained by the current intrinsic value of the option. So that's another important thing to take note of, i.e., the difference between the price of the underlying and the exercise price of the option. Now, let me read that again. In effect, the implied volatility is responsible for that portion of the premium that cannot be explained by the current intrinsic value of the option, discounted to reflect its time value. Now, OCC considers variations in implied volatility within stands to ensure that the anticipated cost of liquidated options in an account recognizes the possibility that the IV could change during the 2 business day liquidation time horizon and lead to corresponding changes in the market prices of the options. Because as you know, IV is highly tied to price. IV goes up, price of the options go up, vice versa when it goes down. Specifically, OCC model variations, or it models variations in IV using its number 1. This is the newer based one that came out in 2022, which is the implied volatility scenarios model for non-S&P 500 based products, and then 2, the S&P 500 IV simulation model for products in the S&P 500 group. And then I guarantee you this Super Note 20 is going to reference that filing from 2022. See generally Exchange Act release number 95319, Super Note 3 at 44168-69. So now we're going to go into the IV scenarios model. So using its current implied volatility scenarios model, OCC models the variations in implied volatility used to reprice non-S&P 500 based options with stands. So again, there's an important thing to differentiate here. The S&P 500 based options use an entirely different model than what we're referring to here. Now, variations in implied volatility are modeled through a volatility surface by incorporating certain risk factors, i.e. implied volatility pivot points, based on a range of tenures, and option deltas. So there you go. There's more interesting information. And then it says right here, the delta of an option represents the sensitivity of the option price with respect to the price of the underlying security. So again, they base their surfaces of volatility based on a range of tenures and options deltas into the models and stands. These IV pivot points consist of 3 tenures of 1 month, 3 months, and 1 year, and 3 deltas of 0.25, 0.5, and 0.75. So again, there's more nuggets for you, those 3 delta values. And this results in 9 implied volatility risk factors. So to see what those are, you would go here and see those 9 volatility factors. I will make another video on that momentarily. These pivot points are chosen such that their combination allows the model to capture changes in level, skew, i.e. strike price, convexity, and term structure of the implied volatility surface. The implied volatility scenarios model has certain limitations related to short-dated options. First, the underlying prices and implied volatilities generated from the smoothing algorithm, which are an input to the implied volatility scenarios model, are generated using a calendar day convention which is not consistent with the trading day convention used in the calibration of the model parameters. The misalignment in day count conventions may result in over or underestimation of options prices based on the implied volatility scenarios. Short-dated options are more sensitive to day count convention alignment than contracts with longer expirations due to the proportionally larger difference in time to expiry between the trading day convention and calendar day convention for shorter dated tenures. Second, the model imposes a flat term structure on short-dated options, which forces the use of the implied volatility shock from the 1M tenure on all options contracts expiring in less than 1 month, 1M meaning 1 month. Because the term structure for the implied volatility scenarios model starts at the 1 month tenure, the current model is not consistent with the observed dynamics of the underlying assets in the implied volatility surface for SDOs. This may lead to inadequate coverage for portfolios with concentrations in short-dated options. Now, the S&P 500 implied volatility simulation model. OCC uses the S&P 500 IV model for the S&P 500 product group. The purpose of the S&P 500 implied volatility simulation model is to establish a consistent and robust framework for IV simulation and provide natural offsets for volatility products with similar characteristics to S&P 500 implied volatility. The output of the S&P 500 implied volatility simulations model is used by OCC's options pricing model as well as the volatility index futures model. Again, this is all referenced in the OCC filing back in 2022. The S&P 500 volatility simulation model is a Monte Carlo simulation, there you go, more nuggets, that captures the risk dynamics in the S&P 500 IV surface utilizing standardized log moneyness and a fixed number of key tenures as well as skew to generate an S&P 500 1 month at the money risk factor. OCC then uses the generated implied volatility scenarios to produce option prices and margin estimation and stress testing. Now, the S&P 500 IV simulation model has certain limitations related to short-dated options, much like the previous model we were discussing. Like the implied volatility scenarios model discussed above, the S&P 500 implied volatility simulation model uses a trading day convention and the calibration of the model, which is not consistent, just like the other one, with the calendar day convention used in the generation of the input from the smoothing algorithm. As for the implied volatility scenarios model, this misalignment may result in over or under estimation of option prices, particularly for short-dated options. Second, the S&P 500 implied volatility simulation model uses a fixed number of key tenures beginning with the 1 month tenure. Because the term structure for the S&P 500 implied volatility simulation model starts at the 1 month tenure, the current model is not consistent with the observed dynamics of the underlying assets and the implied volatility surface for short-dated options, which may lead to inadequate coverage for portfolios with concentrations in short-dated options. I'm not going to get into the CST, but I just wanted to go into that in more detail so you can understand that no matter if you're trading short-term options for S&P or not, this is going to be affecting you because it's going to be affecting how the OCC models its options pricing. And so if you've been into a strategy and it's been working, this could be a possibility that might change things, just something to keep in mind. Last thing I'm going to go over is volatility shocks. Volatility shocks model component, this is a component of the CST, provides a method to generate IV and a stress scenario for all individual option products that are cleared by OCC. The model component is used to shock any option product cleared by OCC. Shocked IV is needed at the product, expiration, and strike level to evaluate individual option implied volatilities in stressed market conditions, which is then used to determine option prices and calculate the profit and loss of clearing members' accounts in stress scenarios. For all systemic stress scenarios, the SIBO Volatility Index, or VIX, is used as the main risk driver in determining shocked implied volatility. That is important to note. That's basically it. If you want to read the rest of it, I'll link this down below. And again, they are going to change this by aligning the day count with the prior, or they're going to align it with the trading convention that doesn't take into account dates that aren't trading days. So I will link this below, but that's basically it. If you're an options trader, this is highly relevant. I would definitely take a look at this. In the impact analysis, they've reviewed the impact of this proposed change on margin across all clearing members over a 15-month period. So again, they're always back testing their models. And this test happened between July 23rd and September 2024. OCC observed that the proposed enhancement would lead to an average daily total margin increase of 0.58% or approximately $0.2 billion, calculated based on the average daily margin of nearly $38 billion. And this is across all accounts and activity dates, with the daily total margins falling in a narrow range between the largest decrease of 0.81%, approximately $0.3 billion, to the largest increase of 3.21%, which is $1.1 billion. The results further demonstrated that the SDO enhancements had a larger measurable impact for accounts with high concentrations of short-dated options. So again, be very careful here. Most people trade short-dated options, so if they're going to be messing with the pricing calculation, I would definitely pay close attention to your strategies and make sure that you're taking this in and noting any changes. So that's basically it. Y'all have a good one. If you would like to read any more about this, I will link it in the description below. Have a good evening.